liquidity goes in 5 to 6 year cycles. The last cycle bottomed out, and it's going to be 5 years coming at the end of this year, I believe. So his point is that liquidity is going to peak at sometime in the first quarter of 2026. Okay. So you would think, well, that means Bitcoin's going to peak in the first quarter of 2026.
Yep.
Not so fast, because what happens is Bitcoin lags by about 3 months, by about 10 to 12 weeks. So now Bitcoin's going to lag that. So if all things being equal, you don't have a market shock, which takes everything I'm talking and
throws out the window.
Right out the thing. Yeah, exactly. But if we don't have a market shock and we just keep doing what we're doing through the end of this year, then I think that Bitcoin's going to peak out somewhere in the first quarter of next year. I think we're going to be 150, 180 by the end of this year.
James Lavish starts by zooming out to give us the big picture. The global economy, he emphasizes, is not just based on supply and demand, it's built on debt. Every aspect of our financial system hinges on borrowing, leverage, and continuous expansion. This creates a kind of debt treadmill, where the only way to keep the system functioning is through consistent liquidity injection.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
The assets like gold and Bitcoin, and really attaches the cyclical values of that to the cyclical expansion and contraction of liquidity. Okay, why does liquidity matter? Everybody talks about M2, and that is very important. It's part of liquidity. But what liquidity is, we're living in a debt structure economy. So the whole world, it's not just the US. I mean, our whole foundation is built on borrowing, leverage, and debt. And so that means that you must have expansion of leverage and debt to keep going.
Yeah.
By definition. So what happens is you're looking at this cycle of liquidity, and that's a whole bunch of things. And again, it's like it's the amount of it's central bank liquidity, QE, that kind of stuff, or acronyms that create liquidity, or not terming out debt, that stuff. It's shadow banking, which is like hedge funds,
and like the Eurodollar market.
Lending, yeah, Eurodollar. It's all of that stuff. And one of some of the factors that go into that are not just the amount of bonds that are out there or whatever, but it's the amount of collateral that is needed to borrow. And so when you have volatility in the markets, the increase in volatility means that you have an increase in margin. Why is that? Because when you have a really big increase in volatility, it's usually because you're seeing drawdowns. And so you have the banks and the prime brokers raise the minimum collateral, which is called the haircut. So if you're going to go buy a stock, you're going to go buy an Apple or a Microsoft, and blue chip S&P stock, you would typically have to put down 6% for that, and you would get portfolio margining on the rest of it. You could borrow 94% against it. But then in the times of shock or times in high volatility, that 6% might move up to 20, 25%, which we saw in the great financial crisis, even in blue chip stocks. And so that means that you need more liquidity. You need more collateral for that borrowing, which brings down the borrowing, because you're obviously going to sell part of your position to get enough collateral to secure that position with your lender. And so that draws liquidity out of the market. So when you see high volatility, that's not good, especially in bonds, because bonds are the base asset to borrow against in repo markets and shadow banking repo markets, not just with the Fed. And so that's bad. When you see the MOVE index get higher, that's bad for liquidity.
About this. Yeah.
Yeah. So, and that's the issue, right? And so, I think Jack and I have talked about it. So that's the issue, and that's part of the calculation. Okay, so this goes back to your question, what do I think is going to happen with Bitcoin this year? Well, I still think that we're expanding liquidity, and you can see it. You've seen liquidity expanding recently. And so, and Michael's studies have shown that liquidity goes in 5 to 6 year cycles. The last cycle bottomed out, and it's going to be 5 years coming at the end of this year, I believe. So his point is that liquidity is going to peak at sometime in the first quarter of 2026. Okay. So you would think, well, that means Bitcoin's going to peak in the first quarter of 2026.
Yep.
Not so fast, because what happens is Bitcoin lags by about 3 months, by about 10 to 12 weeks. So now Bitcoin's going to lag that. So if all things being equal, you don't have a market shock, which takes everything I'm talking and
throws out the window.
Right out the thing. Yeah, exactly. But if we don't have a market shock and we just keep doing what we're doing through the end of this year, then I think that Bitcoin's going to peak out somewhere in the first quarter of next year to, half, like the first quarter, the first half of next year, it's going to peak out. I think we're going to be 150, 180 by the end of this year. I don't know where the top is, because if we get into one of those blow off top instances,
the big euphoria.
It could be 300. It could be, I have no idea, because it's so misunderstood right now.
Totally.
And so that's the big thing. Going back to institutional investors, that's the big thing. Yeah, we got the ETFs, but that's not the watershed event. The watershed event is when you have somebody big enough who understands it, gets it, adds it to their treasury, like an Apple or Microsoft or something like that, like one of the biggest companies in the world, or Amazon. Then it starts this watershed of everybody's like, wait a minute, this thing is really for real. Like, I've got to go get up to speed on it. Let me get some while I get up to speed on it. And that's when you get broad understanding, because then it's like, well, this is clearly here to stay. This really is digital gold.
Countries are beginning to ask, do we really want to hold these dollars that are being rapidly debased? If confidence in the dollar fades, the entire debt structure becomes more fragile. Lavish cites Michael Howell's research, which argues that the 10-year Treasury yield should already be over 5% based on market risks, but remains artificially low due to how the U.S. Treasury is managing its debt issuance.
Structural privilege, being the global reserve currency, gives us privilege that we get to run all these deficits with the global reserve asset, because fiscal deficits. Trade deficits, fiscal deficits. So meaning that our government spends more than we create through GDP, right? So, which means our tax dollars are lower than what we spend. So the structural privilege is that, well, because we have the US dollar, well, we can be irresponsible over here with our spending, because everybody needs dollars. So, and almost have to be, because everybody needs dollars. They need debt to use it. That's, we need to keep, like, we just keep issuing debt. And so the privilege is we get to overspend. Everybody has to get these dollars that are being debased rapidly. And that's the privilege. It's structural. And it's now people are looking and saying, hold on a second, time out. Is this really the way we want to, do we really want to own these?
Yeah.
Truly. And so, Michael Howell argues that he just put out a newsletter this last few days, and he argues that the 10-year should be trading above 5% already. It's at 4.5%. But he's like, the 10-year should be trading above that, because the issues that we have are being, they're actually being swept under the rug by the way that we're issuing bonds. And what I mean by that is that Scott Bessent criticized Janet Yellen. Really, he was really critical of her over the last, few months before he took over in the campaign. But he was really critical that she had not termed out the debt.
Yeah, she'd been issuing everything on the short end.
Everything on the short end. So for your listener, meaning they didn't issue a lot of 10-year, 20-year, 30-year debt. They stayed in the short belly to the T-bills.
Like the 1 to 3 year kind of range.
Correct. And so, or even less than that. So now you have all this debt that's being issued on the short end, which makes it easy for investors to buy, because there's really no duration risk or interest rate risk, so you can buy those easily. And so, but it's artificially it's kind of QE. It's kind of yield curve control.
Because those bonds are more money-like than the long duration.
Correct. They're treated more like money. The money market, when you buy a money market, on your Fidelity account, you're buying bonds. You're buying T-bills. That's the money market and the repo. That's what you're buying. So,
and then Bassem came in after criticizing it for doing that and did the same thing.
He realized, oh my God, there's nothing I can do here because
there's just no demand for long duration.
Well, he made the bet. He made the bet that the Fed was going to lower rates enough that he'd be able to term out some of it, but they haven't. The 10-year's still at 4.5. So if he starts terming out now, he makes the interest payments for the U.S. He locks in that the deficit we're already running. He makes those interest payments. It's already at 1.1 trillion. They're going to be even more. So he doesn't want to do that. So they're still playing chicken with the Fed. And so, some people speculated that Trump was trying to crash the market enough that the Fed would step in and say, oh yeah, we'll lower rates, but they didn't. And, did Trump, was he trying to do that? And then did he blink because the market did crash and there was no movement from the Fed and they still were like, we don't care. We're not concerned about the stock market. We're concerned about inflation and unemployment. I don't know. The UK is trading at 22. It's $22,000 per 10 million. France is, so you have the UK, Germany is trading at 13.9 or 14, right? I mean, pretty good. Sweden, 13, Netherlands, 13, Switzerland, 11. Okay. Japan, 19.
Even though Japan's going through an absolute meltdown.
Isn't that interesting? Okay. So, but they have demonstrated they will
backstop everything.
Backstop every single thing. Exactly. So Australia is 13.7. Okay. So what about the weaker countries in Europe, right? So what we call the pigs, Portugal, Italy, Greece, and Spain, which were back in the great financial crisis, they were all in distress.
Yeah.
And so Greece was kind of forced to restructure their debt. So
Greece is like the economic basket case of Europe.
Correct. Right. So you would think, those would all be worse than the United States, right? Well, Italy, 55. Remember, the United States is 56. Okay. Portugal, 27. Spain, 36. And Greece, the worst of them all, 57.7.
That's wild.
Yeah. So the U.S. is right there with Greece.
Here's where things get even more concerning. Rather than locking in long-term debt at low interest rates, Treasury Secretary Janet Yellen chose to issue mostly short-term debt. This increases rollover risk and interest payments. Her successor, despite criticizing this policy, has continued it. Why? Because moving to long-duration bonds now, at high yields, would explode interest payments and worsen the deficit crisis. Please like and subscribe.